Long-term assets. There are three types of long-term assets. One, plant assets, are better known as property, plant, and equipment. The next is natural resources, and the third is intangible assets, which do not have a physical form. Long-term assets in general, they have a useful life of more than one accounting period. They're different from something, say, like supplies, which we consider to be an asset because it's going to be used up over a more longer period of time than, say, like 2 weeks or a month. But typically, long-term assets are not current assets because they are going to be used up later than the typical accounting cycle or for more periods of time than the typical accounting cycle, generally between 3 and 30 years, just depending upon the asset type. They are used in operations to produce income. So these are like cash registers, building, fixtures, furniture. They're used in order for the company to be in business and conduct business. And it's not an investment or something that is otherwise idle. So if a company were to purchase land as an investment, it would not be considered a long-term asset, and it would not be considered in this category of assets, but it would be considered a part of one of the company's investments. Or if it's otherwise idle, if they purchased a building that's standing idle, it would be considered an investment, but it would not be in an income-producing long-term asset section of the balance sheet. To match the cost of the asset against the income the asset helped to produce, depreciation is expensed in a consistent manner, and a contra-asset account called accumulated depreciation collects or accumulates all depreciation for the asset from the time the asset was placed in service. We saw this when we did adjusting journal entries, so this is depreciation expense and accumulated depreciation. This is the contra-asset account, accumulated depreciation, and it is combined with the asset account associated with the accumulated depreciation. Net book value. Now let's understand some very specific terms that we're going to be using and precisely what they mean. When we speak about net book value for an asset, we are talking about the cost of the asset minus its accumulated depreciation. So cost minus the associated accumulated depreciation yields net book value. Now, when we talk about the depreciable base of an asset, the base or the amount that we are going to depreciate, that is the cost of the asset minus a salvage value. So cost minus salvage value is the depreciable base. Plant assets in general. Now we're specifically going to talk about plant assets. All plant assets except land are depreciated. Land acquisition costs are separated from the cost of any land improvements. Land acquisitions and cost include the removal of a structure less any salvage value to prepare the land for use. So it's everything that you are doing in order to place the land and prepare it for use, and to purchase the land and prepare it for use. Now there will be things on top of the land which are considered land improvements. It's unlike land in the fact that it will be depreciated, and it includes such items as parking lots, fences, signs, shrubs, and lighting systems. All of these are placed on top of the land, and they depreciate, and therefore, and they will be used up, and they will have wear and tear, so they will be depreciated. So the cost of the land and the land improvements are separated because one is not going to be depreciated, the other one will be depreciated. When considering what expenditure should become part of an asset cost, consider what is normal, reasonable, and necessary to prepare a plant asset for its intended use. So, for example, if you have to use a police escort to move a very large piece of equipment down the highway, and you pay for that privilege of doing that with a license to do that, then that would be considered a normal and reasonable expenditure in order to prepare the plant asset for its intended use. However, if you're trying to speed something to a work site as part of the cost of an asset in order to place it into service, and you receive a speeding ticket, then that would not be considered normal, reasonable, or necessary to prepare the plant asset for its intended use. If a company purchases several items together, it's called a lump sum purchase. The cost of the purchase must be divided amongst the assets and the accounting records. So you bought everything at one price, and now you've got to divvy up that cost, the amount that you paid, among all of the various assets in the accounting records, because they probably will be depreciated at different rates. The division of this cost is based upon the appraised value of the individual assets as follows. Let's look at this calculation. So typically what will be done is you will have the land, the building, any equipment, anything you're purchasing appraised, because you're trying to determine what the amount that you're going to pay for it, is it correct in relationship to the market value or an appraised value. So you're going to accumulate the market or appraised value for all of the individual components that you're purchasing. In this instance, we're using land and building. The land was appraised at $30,000, the building at $90,000. So the total appraised value of what the company is purchasing is $120,000. Now, the company is purchasing it at $100,000, so it's getting a bargain purchase. But how to take this $100,000, which they are using to purchase the land and building, and then divvy it up amongst what should be in the records for land and what should be in the records for building? Well, the way to do that is to take their proportions of the market value and multiply it by the amount paid. So let's look at that. So we could take 30,000 divided by 120,000, or 90,000 divided by 120,000. We could abbreviate it to 3/12 or 9/12, or we could just simply say it's 25% or 75%, however you want to calculate it. But 25% of the $100,000 that you are paying for both the land and the building will be placed in the general ledger as the value of the acquisition cost of the land. 75% of the $100,000 or $75,000 will be placed in the general ledger records as the cost of purchasing the building. So the total general ledger value will equal the amount of cash that they actually paid. And the journal entry would be to debit land and building for the amount paid, and notes payable, or perhaps it could be cash, for $100,000. Now let's look at another issue related to plant assets, calculating depreciation on the plant assets. So depreciation is the process of allocating the cost of the plant asset to expense in the accounting periods benefiting from its use. So we're taking the plant asset, the asset value, and now we're converting it to expense in order to match it against income. So let's look at the factors in computing depreciation. There are several factors. First of all is the cost of the asset, which is objective. We were able to determine through records and cancel checks, etc., what precisely we paid for an asset. Next, we would take into consideration salvage value, and third, the useful life. The cost of a plant asset consists of all the necessary and reasonable expenditures to acquire it and to prepare it for its intended use. There are many examples in your textbook of the types of costs that would surround the different types of assets that you would purchase. And since most of us aren't often involved in purchasing large assets, it would be a good idea to take your textbook and look at the types of costs that typically surround the different types of assets a company could purchase. But we're just going to talk about things in general in this YouTube video. So let's look at salvage value. It's an estimate of the asset's value at the end of the benefit period. If it was a truck, perhaps it would be based on Kelley Blue Book values at the end of the accounting period that intends to be used, and you would use that as your salvage value. Next, let's consider useful life. It's also an estimate, and it's the length of time it is productively used in the company's operations. So the useful life of a plant asset, you may look at a truck and say this should last 10 years. But if the company has a length of time that's less than 10 years and intends to use the truck, then it would depreciate it over the time period that it intends to use it. So say, for instance, they trade in their trucks every 3 years. So even though the truck would last 10 years and be used productively for 10 years, if the company only intends upon using it for 3 years, then it would be depreciated over 3 years. We will learn about 3 methods of depreciation: the straight line method, which is most commonly used, the units of production method, and the double declining balance method. Of the straight line and units of production are relatively easy to use. The double declining balance takes a little bit more time to learn. So let's look at this example. We have a truck that cost $11,500, a salvage value of $1,000. It's a useful life of 5 years, which we'll use in straight line depreciation. And then it could also be depreciated using expected miles, which is the unit of production method. Typically, when you use the unit of production method, it means that the asset is used intermittently over the year. And so, for instance, if you were doing a timber operation and you were only able to get up into the timberlands for certain months of the years, you wouldn't be using the truck throughout the year, but only on certain specific portions of the year. And so you may want to use the unit of production method. And you'll understand more about it when we look at it in detail. So let's look at straight line depreciation. I'm going to teach you both to look at it on a full or partial year. So to determine the months an asset should be depreciated in a period, consider the date the asset was placed in service and the date for which you are preparing financial statements. So it could be a full year and it could be a partial year. I'm going to teach you how to do it the same way each time, so it won't matter whether it's a full year or a partial year. So a full year. If an asset was placed in service on January 1 and the company is preparing financial statements as of December 31st, 12 months of depreciation will be recorded. If it's a partial year, say for instance, if however the asset was placed in service on July 1st, then that would mean it would be 6 months and the financial statements are prepared as of December 31st, then 6 months of depreciation will be recorded. So we're going to do the same thing whether it's a full or a partial year. We're going to take the cost minus the salvage, which will give us our depreciable base, and then we're going to divide it by the number of months the asset will be in production or its useful life. So we said 5 years, 12 months, so that will be 60 months. The depreciation per month will be $175. We're going to multiply that by 12 to get an annual depreciation. So our annual depreciation would be $2,100. I believe in being consistent, especially when you're trying to learn something. So we will do the same thing so we can use the same calculation, whether it's a full year, which is this calculation here, or a partial year, which in this instance I'm showing the calculation for 6 months, and then I'll show it to you again for 4 months. So we're going to use the same depreciable base divided by the same number of months in its useful life, 5 years times 12, 60 months, $175 per month times 6 months. This would be it for a partial year depreciation. 4 months, same calculation. We're going to take the 175 and multiply it by 4, and our depreciation would be for 4 months. Again, always either write out or count out the number of months. Some people will hear or read that an asset was placed into service on June 1st and assume that that's 6 months, but it's not. It's 7 months. So always be careful in counting out the number of months the asset was placed in service in relationship to the financial statement date. So the adjusting journal entry, we know this already, right? For a full year, depreciation expense, accumulated depreciation, $2,100. Now let's look at book value. We learned earlier when we learned about adjusting journal entries about depreciable base. Now we have to learn about book value because that will come into play specifically when we're looking at asset sales and disposals, as well as learning and understanding how accumulated depreciation works. So book value is cost minus accumulated depreciation. So salvage value is not a component when we talk about book value. So let's look at our adjusting journal entry for year 1, 2100, our balance and accumulated depreciation, 2100. Adjusting journal entry year 2, 2100, the balance and accumulated depreciation is now 4200. We repeat the same pattern for year 3. 6,300 is the balance and accumulated depreciation. Year 4, balance will be $8,400. Year 5, the balance will be $10,500. Now let's look at how we would compute book value. So book value is cost minus accumulated depreciation. This is our cost each year. Then this is our accumulated depreciation. Year 1, $2,100. Year 2, $4,200. Year 3, $6,300. 4, $8,400. $10,500 in year 5. We can see that this is the book value. So it's $9,400 year 1. $7,300 year 2, $5,200 year 3, $3,100 year 4, and then we see that our ending book value will yield our salvage value because we depreciated it based upon the depreciable base. And so our book value should yield at the last, after it's been fully depreciated, it should have a salvage value, which would be the cost minus all accumulated depreciation. So now let's look at the units of production method. Again, we said we would use this when we use an asset intermittently throughout the year. So we have the same truck, the same depreciable base. Now we're going to divide it by the total units of production that the equipment is supposed to yield. This could be a shoe machine, and it's supposed to produce 36,000 shoes. But we're just going to use the same truck to be consistent in our example to make it easier for you guys to understand it. So this is our depreciable base. We're going to divide it by the total number of units that we expect to use the truck for the 5 years we expect to have it in service. So our depreciation per unit or per mile will be 7 cents per mile. So in the first year, we used 50,000 miles. We recorded 50,000 miles in the truck. And so our year 1 depreciation will be $3,500. The next year, we're going to use 45,000 miles times the 7 cents. Year 2. Year 3, 30,000, 2,100 in year 3, 15,000 year 4. Year 4, our depreciation will be $1,050. Year 5, $10,700. And so the total number of units in each period, the depreciation should come back to the total number of units that you expect to use the asset. So now let's look at the book value for this. First year is $3,500. Second year, $6,650 is our accumulated depreciation. Third year, $8,750. Now notice our adjusting journal entries are varying because the asset is being used at varying levels for all of these years, but we still come down to our ending balance and accumulated depreciation of $10,500. So let's look at our book value, which is cost minus accumulated depreciation. We see our accumulated depreciation for each of the 5 years. We can see our book value for each of the 5 years, and it yields the same ending salvage value. Now, let's look at double declining balance. This is going to take a little bit longer to understand, and it's a little bit more difficult calculation. So the double declining balance rate is applied to the beginning book value. So you're going to have to calculate book value each individual year, the beginning book value, in order to calculate the amount of depreciation for each individual year. So let's look at the calculation. The calculation is to take 100% and divide it by the number of years in the useful life. So 100% divided by 5 useful years, means our straight line rate is 20%. Then we're going to multiply our straight line rate times 2, and that will yield our double declining rate. So in year 1, we are using beginning book value, so there's no depreciation recorded or accumulated depreciation. So we're going to use our book value, cost minus accumulated depreciation. So that is $11,500 minus 0 accumulated depreciation. So our first calculation will involve $11,500. Notice it is cost that we're using here and book value, not depreciable base. So in using the double declining balance rate, we are not going to be using depreciable base. We're using net book value. So net book value times 40%. In the first year, our depreciation is $4,600. Now the next year, we have to calculate our beginning book value. So that is going to be the cost of the asset minus the accumulated depreciation of $4,600. So now our net book value at the beginning of year 2 is $6,900. So we're going to multiply that by 40%, and our depreciation for the year will be $2,706. Doing the same thing in year 3, we're going to take our net book value and we're going to subtract out the most recent accumulated depreciation, or you could do it $11,500 and add these two together. I just find that it's easier to look at it incrementally by just bringing down the total each time. So I kind of do it a little bit different. So we're going to use the accumulated depreciation is in this number when we bring it down from the prior year, so we're just going to subtract the current year. But if you were, and when we see it on the next slide, I'll show you how it yields the total accumulated depreciation. But we'll do the calculation like this because it's the easiest way for you to do it. So we're going to take the amount of our depreciation for the year, subtract it from the beginning balance of book value that we had, and then we'll come up with a new balance of a new beginning book balance, book value. And so then we'll subtract, calculate out the current year depreciation, subtract that again from the beginning book value, come up with the new book value, multiply that times 40% and come down. And then at the end, the last year, now this is when salvage value comes into play, we're going to take the 1,490 and then we're going to subtract out the salvage because we're not going to depreciate beyond the salvage. And so now our depreciation for that year will be $490. Now let's kind of put it all together. This is just the easiest way for you to calculate it if you want to calculate it a different way, but I just found over the years that it's just easier for students to record this, because typically what you'll have on a test or on a homework question is it will only go down 2 or 3 layers. So this is just a much easier way to calculate it. So let's look at this. So our accumulated depreciation, we have $4,600 in the first year. Our depreciation for the second year was $2,760. So our balance in accumulated depreciation is $7,360. Our third year depreciation was $1,656. So our balance in accumulated depreciation at the end of the third year is $9,016, and so forth and so on. So let's look at our book value at each individual year, and this is our ending book value, so that's why it's easier to calculate it incrementally, I think. So let's look at our cost minus our accumulated depreciation, and this are all our book values for each of the individual year, and that will be our salvage value at the end. Now let's look at another issue. When we have plant assets, there could be changes in the depreciation estimates. Depreciation is based on estimates of salvage value and useful life. During the useful life of an asset, these estimates can change. Use the new estimate to compute depreciation for current and future periods. So there's several steps that you should follow. First, bring the accumulated depreciation up to date. Take the current book value, cost minus accumulated depreciation, and subtract the new revised, if this is applicable, salvage value. And then you're going to divide that by the revised, if applicable, remaining useful life. So let me show you an example of this. So we have a plant asset with revised depreciation. The revision will be made in year 3. Instead of depreciation for 36 more months, the company will depreciate for 48 more months. So here we have an asset, the cost minus salvage, and a depreciable base. We assumed 5 years. This is our per month depreciation. Annually, it will be $1,800. So at the end of year 2, when the accumulated depreciation is $3,600, so this is year 2, $10,000 cost minus accumulated depreciation of $3,600, or a book value of $6,400. At the end of year 2, they decide we're not going to depreciate it at depreciate this asset for 3 more years or 36 more months, we think we have another year of that we are going to put the asset into use. So now we want to depreciate it for 4 years instead of 3 years. So how would we calculate that? We look at the book value at the end of the second year, which means it's also the beginning of the third year. They have the cost minus our accumulated depreciation, and this is our book value. So now we have a new salvage value of $40,000. So remember, this is cost and accumulated depreciation. It does not have a component of salvage in it. So now we're going to deduct our new salvage value, and our new depreciable base will be $6,000. Now, instead of depreciating it over another 36 months, we've determined that we're going to depreciate it over another 48 months or 4 years. So now we're going to have the remaining useful life in months of 48 months. So now our new depreciation will be $125 per month. And so we'll multiply that by 12 to get an annual depreciation rate of $1,500. So this was the prior depreciation calculation. This was our balance in accumulated depreciation. So now beginning in year 3, we're going to depreciate it for 4 more years. So we are going to depreciate it at the amount of $1,500 as opposed to $1,800. So the adjusting journal entry in year 3, 4, 5, and 6 is going to be $1,500. So 1, 2, 3 years, 4, 5, and 6. This is the cost. This is the old depreciation calculation. This is the new depreciation calculation. And we can see by taking cost minus the accumulated depreciation, we will wind up with our salvage value. And we know that we've done this correctly. Plant assets, a balance sheet presentation. Plant assets are shown on the balance sheet net of accumulated depreciation. This helps the readers of the financial statements compare assets and determine how long the assets have been in service. So a balance sheet presentation, if we have property, plant, and equipment of $50,000 and accumulated depreciation of $25,000, we will show net property, plant, and equipment of $25,000. Well, this will let readers of the financial statements know that these assets have been placed in service for a very long period of time, as opposed to looking at another calculation where you have property, plant, and equipment and you only have accumulated depreciation of $1,500. Well, obviously these look like newer assets, and that may be very important to the reader of a financial statement. So if the financial statements were just to show $25,000 and $48,500, it would not yield as much information as when you can see how much the accumulated depreciation is. And this is the reason why they break it out like this, is to give the readers of the financial statements enough information to determine if this is a company that they want to invest in. It's very asset intensive and needs new assets in order to be a viable company. They'll be looking at companies that have newer assets. So let's talk about disposals or sales of assets. Plant assets can be discarded or sold. If disposed of, there can only be recorded a loss on a disposal. So let's look at the steps. These are the journal entry steps. First, we want to credit the asset based upon the general ledger amount, correct? We carry an equipment, property, plant, and equipment as debit based, as it increases with a debit. So now we want to credit it because we're disposing of it, so we're taking it off the books. Next, we want to debit the accumulated depreciation based on the general ledger amount. So accumulated depreciation is $5,000, and so this is a fully depreciated asset, and so there will be no loss on the disposal. So if the asset is not fully depreciated, we're going to record a loss on disposal for the difference. Note, there can only be a loss on an asset disposal. So this is a fully depreciated asset, no recording of a loss on disposal. In this instance, we have an asset for $5,000. The depreciation, the accumulated depreciation, is only $4,500, and so there will be a difference between the amount that, or book value. The book value will be $500. So the asset minus accumulated depreciation, book value $500. And so the $500 also represents the loss on disposal. So asset not fully depreciated, difference between the credit side of the entry and the debit side of the entry will be recorded as a loss on disposal, and it also happens to represent net book value. Now let's look at a sale. A sale of an asset, even though the general ledger accounts use the title gain or loss on a disposal, if cash is involved, it is a sale, and there can either be a gain or a loss. So if we're using cash, even though the account title is saying the same as when we talk about the disposal in the prior slide, it's a sale, and there can be a gain or a loss. So let's look at the journal entry step. Same as in the disposal, we're going to credit the asset, debit the accumulated depreciation. We're going to record the cash that's been received, and then any difference between those amounts we will either debit a loss on asset disposal or credit a gain on asset disposal. So let's look at something where we sell the asset for book value. So we have equipment on our books of $5,000, accumulated depreciation on the equipment of $4,500. We receive cash in the amount of $500, which also equals our book value. And so this would be no gain or loss recorded on the sale of this asset. Now, if the asset is sold above book value, in this instance, our equipment costs $5,000, our accumulated depreciation is $4,500. We received cash of $1,000, so we can see the debits here don't equal the credits unless we record a gain on disposal. So a gain on disposal goes to the income statement and other revenues and expenses. So this is an income statement account, and we will record a $500 gain. Now, what happens if we sell it below book value? Well, again, we will credit the asset, debit accumulated depreciation, credit the cash that we received for the asset. Now we see that our debits are $5,000, our cash is $350. Accumulated depreciation, $4,500. We can see our debits and credits don't agree. So there must be another debit that we must need, and that would be the loss on disposal of $150. And that also makes sense because the book value is $500. Our cash that we received was $350, so the difference would represent the loss. Natural resources. This is our second type of assets. These are assets that are physically consumed when used, such as timber, mineral deposits, and oil and gas fields. The cost includes all necessary and reasonable expenses to acquire and prepare the asset for its intended use. We are going to record depletion, not depreciation, to allocate the cost to the period when it's consumed, and we will use the unit of production method to record depreciation. So we have a oil field that cost us $700,000, depreciable base $700,000, no salvage value. We're expecting to produce 70,000 barrels of oil, so the depreciation per unit will be $10. The first year we produce 3,000 barrels of oil, so the depletion in the first year will be $30,000. Depletion expense oil $30,000, accumulated depreciation oil $30,000. So everything else as far as the plant assets come into play as far as book value, etc. Next, our third type of asset is intangible assets, and let's just talk about them in general. There is a lot of description as to what the type of assets are, their legal lives, and things of that nature in your textbook, so make certain that you read about these in your textbook. So we're just going to go over some general remarks right now. So these are non-physical assets used in operations. Again, these are used in operation that confer on their owners certain rights, privileges, or competitive advantages. This represents patents, copyrights, licenses, leaseholds, franchises, goodwill, and trademarks. If an intangible asset is purchased, the asset is recorded at cost. If developed internally, only just some limited costs can be capitalized or recorded to the asset. So typically what you'll see, if you see an intangible asset on the books of a company, in all likelihood it was purchased. Assets will be amortized, not depreciation, so we'll use the term amortization. If an asset has an unlimited life, just like land, it is not amortized. But if it has a limited life, then it will be amortized. The cost is amortized over a period. The asset is expected to benefit the company, but can never be more than its legal life. So again, amortized over the life that the company expects to use it, but never more than its legal life. Let's talk about goodwill, which is a specific type of intangible asset that has a specific meaning in accounting. When a company acquires another company, it is recorded. So it only happens when a company acquires another company. It implies that the company that was purchased as a whole is worth more than the value of its individual assets and liabilities. So in this instance, we're going to record where the purchasing company will record the value of the assets that we purchased. And then a lot of times a company will come with liabilities, so we'll have to record the liabilities associated with the purchase of the company. We paid cash in the amount of $125,000 for this company, and the reason why we're willing to do this because the company as a whole has a lot of benefits and perhaps customer base or perhaps executive employees that the acquiring company really likes, or some technology that the acquiring company really likes, and it's willing to pay a premium to purchase the company. And so since the cash was more than the assets minus the liabilities, the company purchased it for more than the company was worth on the face of it, and so goodwill would be recorded for the amount of that difference. Now, goodwill will never be amortized, but each year it is analyzed to determine if it should be written down if it's been impaired in any fashion.